Good afternoon, everybody. This is Josh and Rufus from InTouch Credit Union. Welcome to our InTouch Credit Union Webinar Series. This is our second webinar of 2023, but the first webinar with our preferred partner, Silvur. So we are very excited to have them on board and have everybody here. I am Josh. I am our resident financial counselor here, and Rufus is my supervisor, our other resident financial counselor here. We're excited to have you join us today. Today, we have Rhian, who is the CEO of Silvur, which provides members like you with retirement calculators, tools, and education through Retirement Simplified. Prior to founding Silvur, Rhian worked for 17 years at JP Morgan, where she advised individuals and families on investments, credit, and wealth planning. We're excited to have her here with us today to help you learn about the tax updates and tips that will help you optimize your 2022 tax return. And with that lovely introduction, I'm going to turn it over to the person of the hour.
Well, thank you so much, Josh, and it's a pleasure to be here with all of you today. Josh mentioned before we got started that he had already filed his tax return for 2022, but I imagine for most of you on the phone are probably more like me, that you're starting to get your paperwork organized, but haven't filed it yet. And so, our goal today is to make sure that you're keeping your retirement savings for you and that we're not letting any extra money go to Uncle Sam. We're going to take you through our tax filing guide for 2022 for soon-to-be retirees as well as retirees. But let me just start by giving a little bit of background on Retirement Simplified, which is powered by Silvur. We're thrilled to partner with InTouch Credit Union to really help members who are on this retirement journey, whether you're pre-retirement or early days of retirement, really understand, how you're positioned for retirement and to help you retire with confidence. Through Retirement Simplified, which you can find at itcu.silvur.com. You can get a free retirement score where you can learn how long your savings will last in retirement. It'll include things like Medicare, Social Security spending, and if you're thinking about moving in retirement, will allow you to understand how that move might impact your retirement score. Retirement Simplified also includes holistic retirement education that's personalized for you. And we're going to talk about one of our new classes today, which is our 2022 tax filing guide. But if you go into Retirement Simplified after the webinar, what you'll see is we have a lot of education that you can learn and educate yourself on, 3 to 5 minute topics on topics ranging from Medicare to Social Security, taxes and retirement, cost of living, inflation, and more. So today, as we talk about taxes, we're going to really focus on that topic. But what I want you to know is that if you have any questions regarding retirement, just definitely take a look at itcu.silvur.com. And we hope collectively to be able to guide you through this exciting retirement journey that you're either embarking on or thinking about embarking on. So let's talk about what we're going to cover today. We're really going to focus in on what some of the new things you need to be aware of for your 2022 tax filing. We're going to talk about how soon-to-be retirees and retirees can maximize your return with existing credits and deductions. And then we're going to take a little bit of a step back and just to have some reminders about how Social Security is taxed. For many of our members, Social Security is one of their largest retirement assets. We want to make sure that it's clear, how they're taxed. We're going to talk about how where you live impacts your taxes, and then we're going to talk about managing minimum required distributions, because this is something that maybe a new concept for some, but also some of the rules are changing. We want to make sure that everyone's up to speed on where we are today. So let's start with a little bit about why the change. It is 2023, but we're still dealing with 2022 taxes. Our goal today is really to make sure that you familiarize yourself with everything you need to know so that you can file your tax return with confidence for April 18th, 2023. Many of the updates I'm going to talk about today are the result of annual inflation adjustments that the IRS makes to items like tax brackets. Again, as we focus on these updates, we're really going to focus in on the 2022 data, but I think as everyone is acutely aware, we just went through a full calendar year in 2022 of pretty high inflation, and the IRS has actually already released the 2023 tax numbers, which will have even larger adjustments. So let's dive in. So I want to start with what pre-retirees need to know. And so if you're still working and you're filing your taxes, some of the changes you need to be aware of as you kick off your 2022 tax return will be around the tax bracket increases that we've seen on the federal level, changes to 401k contributions, as well as increases to HSA contributions. So when we go through this, what I really want you to be thinking about, is how do we make sure your money is staying with you rather than going to Uncle Sam? How do we set you up for success in retirement? As we really want to maximize that nest egg for you and reduce the tax burden as we go along. So let's talk about tax bracket. So the one, I would say, silver lining that comes out of higher inflation is that the IRS has actually updated all the tax brackets, and you'll see that every tax bracket has increased, which means that you can earn more money in a tax bracket before you get pushed up to a higher tax bracket. We've just shown you on this page what the tax brackets looked like at the 22% level for a single filer, as well as a married filer in both 2021 and 2022. And what you'll see is that the brackets for a single filer have increased just under $3,000, and the brackets for a married filer have increased by about $5,500 between 2021 and 2022. Now, the important thing to note is that the tax rates have not changed, but what it means is that you can earn more at a lower tax rate before you get bumped up to the higher tax rate. Now, the good news is that when you do your tax filing, the IRS kind of takes care of this for you. So there's no extra new math you need to run, but just important for you to know that you may see that your overall tax obligation has dropped, and it's likely due to the fact that the tax brackets have increased. And so your aggregated all-in tax rate likely has fallen. All right, so let's talk about 401ks. If we take a look at 401ks for 2021 versus 2022, what you'll see is that the IRS is giving you the opportunity to put more money away pre-tax to save for retirement. So they increased the 401k contribution limit from $19,500 to $20,500. They did not increase the catch-up contributions, but those numbers, for those of you on the phone that are over the age of 50, the catch-up contribution of $6,500 allows you to really supercharge your savings as you prepare for retirement. And then finally, HSA contributions have been modestly increased. Let's just take a step back for a second and just be reminded about what an HSA does. An HSA allows you to save in a tax advantage way for healthcare costs in retirement. You can qualify for an HSA if you have a high deductible plan. You also qualify for an HSA if you're not on Medicare already. So this is really a pre-Medicare healthcare saving strategy. Unlike an FSA, which expires every year, your HSA really rolls from year to year. And so you can really use it as an account that grows over time and can be used in retirement for healthcare costs. What's pretty interesting about an HSA in retirement is that it comes with a triple tax advantage. Not only do you get to put money in pre-tax, you can grow your savings tax-free, but also when you withdraw in retirement for healthcare costs, those withdrawals are tax-free. So it's a real, what we call triple tax advantage. There's a modest increase in how much you can contribute this year. So if you're an individual, you can contribute about $50 more. And if you're a family, you can contribute about $100 more, up to $7,300. But again, one of the fact patterns that I see quite regularly is that members, as they're preparing for retirement, perhaps they're retiring early, they're not eligible for Medicare yet, maybe they retire at age 62, and they take on, an ACA plan as a bridge to Medicare. If that HCA plan or another healthcare plan you have, is a high deductible plan, that might be an opportunity for you to think about putting some money in an HSA to get some additional savings ahead of retirement. All right, so let's talk about, if you're already retired, what some of the strategies you need to be thinking about are. And again, similar to folks that are already retired, we're going to talk about the change in tax brackets, but we've also seen some increases in the standard deduction for Americans over the age of 65, as well as some credits and deductions that typically apply only to retirees. So I mentioned this already, but again, the tax brackets have changed. due to inflation, which is allowing you to have more of, earn more within a tax bracket and have less from an adjusted basis taxed over time. Again, we see for a single filer at the 22% tax rate that bracket has increased by $2,700, and for a married filer that tax bracket has increased by about $5,400. We're going to talk about some more of the items that retirees can maximize with their returns as we move into the next section, which is maximizing returns with credits and deductions. So when I think about kind of just good hygiene, there are several tax credits and deductions that can lower your taxes in retirement that we really encourage soon-to-be retirees to take advantage of. We're going to go through these in more details where we think about just really making sure you know what your standard deduction is. We're going to talk about caregiver credits, how to deduct medical costs, how to think about gift taxes and charitable donations, and then finally, retirement plan contributions. Many of these fold directly into your tax return that you'll be filing for 2022. And some of these are strategies just about being smart about your planning for the future. So let's start with the standard deduction. So the standard deduction for your 2022 tax filing actually increased by about 7%. And this again is where inflation is I guess the one bright spot with inflation. For individuals, the standard deduction increased from $12,550 to $12,950. And for individuals that are filing jointly, the standard deductions increased from $25,100 to $25,900. So we've seen an increase of about $800 on the standard deduction for couples. Just keep in mind that if you're over the age of 65, you do get an additional $1,750 for a standard deduction in 2022. This is an example of many deductions or credits that you start to become eligible for as you move into retirement. And so would definitely be encouraging you that if you've hit that magic milestone of 65 and you've been enrolling in Medicare, particularly if you're using an accountant, to make sure that they are looking at the additional deductions that you have access to because of your age. All right, let's talk about the caregiver credit. Many of you may be taking care of family members who are perhaps in their 80s and 90s. And as you take care of elderly family members or dependents, you might be eligible for a caregiver credit. So to qualify the credit, you qualify as long as the individual is at least 17 years old. They have a social security number. You have this parent or qualifying relative who's being supported by you, or someone who's living with you and being supported by you who isn't actually a relative. So a couple things is to keep in mind as you think about caregiver credits. If you are covering uncovered medical costs for your elderly parents, you may actually be able to claim an additional tax deduction, particularly if the costs are more than 7.5% of your adjusted gross income. Also, if you have a child or a dependent that attends daycare, including adult daycare, you might be eligible for credit of up to $4,000. What we know is that caregiving is a huge commitment of time for those that act as caregivers, but it's a huge financial commitment too. And so really encourage everyone on the phone today that if you're acting as a caregiver, that you make sure that you're getting that caregiver credit, looking at that daycare credit, and also if you are spending out of pocket for healthcare costs, that you're looking at whether that might be worth itemizing on your tax return. So let's talk about deducting medical costs. If your medical costs exceed 7.5% of your adjusted gross income, you have the ability to deduct the excess on your Schedule A. If you do itemized deductions, you do need to keep track of what you're spending on medical costs so that you can use the expenses to reduce your tax liability. Let me just give you a quick example. Let's say that your adjusted gross income is about $80,000 this past year, and you had $7,100 in medical expenses. About 7.5% of that $80,000 is $6,000. And so you can deduct the additional $1,100 from your adjusted gross income. All right, let's talk about gift tax and charitable donations. As you're preparing your tax return, it's also a good time to think about, how, gifts, how you're making gifts, and making sure that, you are taking advantage of the gift tax limit caps. You can make a gift tax-free or gift tax-free for $16,000 per person. If you're married, you can double that to $32,000 per person. This is not specifically a tax deduction, but it is a way for you to either lower estate taxes if you have a larger estate, or also just be tax efficient as you give money to family members. I would also just flag that particularly if you're over the age of 59 and a half, that you can actually make charitable donations directly from your IRA. Qualified charitable donations kick in your 70s, where you can make those donations directly and actually not be taxed on the distribution from your IRA. And so you can make it actually a taxless transfer from your IRA directly to a charity. Many retirees who are in their 70s think about using part of their RMDs to fund their qualified charitable donations, again, by making those donations directly from their retirement account. Then the other item I would just flag, and this is just a trend that we're seeing, is that many early retirees actually retire and then they go back to work full part-time. And so just want to flag that whether you're working full-time or not even working at all, that you do still have the ability to continue to make contributions to a traditional or a Roth IRA account. So just factoring that in is that if you have that extra cash flow, that ability to put savings away for a tax advantaged retirement savings account. All right, let's go into Social Security taxes. And we're going to take a little bit of a step back here from your filing for 2022, and just really want to make sure that we all understand what income is actually taxed. And I think the big surprise that we hear from many soon-to-be retirees is that their Social Security is taxed. So it's likely that Social Security is one of your largest retirement assets when you think about how much you will receive over the course of a 25 to 30-year retirement. And while many of us think about us being taxed on the way in because we're paying into the system, the reality is that when you get your benefit, when you elect Social Security between the ages of 62 and 70, the benefit actually is taxed. And that, I think, is a big surprise for members, because many members are thinking about the fact that they paid this tax into the system and aren't expecting it to be taxed on the other side. So let's talk a little bit about, how it's taxed and how much is taxed. So depending on whether your filing status, whether you're filing jointly or individually, there are different brackets. The example we have here is for individuals who are filing jointly. And what you'll see is that if you have income greater than $44,000, up to 85% of the Social Security is taxed. Now, just because IRS likes to make it a little bit complicated, they have a special definition of income. It's not your AGI that's on your tax return, but your accountant can help you figure out the specifics there to really understand, what income gets factored in when you factor in how much of your Social Security is taxed. The other thing I would just flag is that if you have just started taking Social Security, that Social Security taxes are not automatically withheld. And so you either need to be filing a estimated tax payment for your Social Security, or you need to ask for a Form W4V, Form W4V, and that form will allow you to get withholding automatically on your Social Security. So it feels more like your kind of paycheck that you have received kind of after tax while you were working. I think we find many members prefer to activate the withholding so they don't have this big tax liability at the end of the year. And so I would just flag that as something that is worth doing if you like to have predictability in what your tax obligations are. The other thing that's interesting, particularly if you're thinking about moving, is that not all states are the same on how they treat Social Security. So, for example, there are 12 states today that actually tax Social Security benefits. Of course, the states are, have their own unique set of rules. Some offer some exemptions. Some have other tax credits that help offset Social Security taxes. And some states like Minnesota actually tax every single dollar that you are receiving. I think, again, there is no free lunch. So we think about states like, New Hampshire and Tennessee. They don't tax earned income or wages, but your dividends and interest income will be taxed in these states. When you take a look at the Social Security, again, some of the nuances I would say here is the devil's in the detail. In Colorado, there's an income deduction of $20,000 for individuals over the age of 55. And that's really in place to help offset the taxation of Social Security. In New Mexico, there's a tax credit of up to $8,000 to offset taxes on Social Security if you're over the age of 65. So I just flagged, there's a little bit of complexity here, but I flagged this because I know a lot of soon-to-be retirees think about moving in retirement, and I would just encourage you to make sure that you know not only what the state tax is, but also understand what the specifics are around taxes of different retirement income streams that you may be receiving. All right, so let's double down on this where you live, how that impacts your taxes. So, I think one of the things that, a lot of members are focused on is making sure that they keep their retirement savings. They're not giving too much of it to Uncle Sam. What's become very clear over time is that where you live in retirement could be one of the biggest decisions you make. And here, what I would just say is that oftentimes members think about the state taxes in their decisions. I would encourage you to go a level deeper and think not only about state taxes, but Social Security, property taxes, sales taxes. Often states that don't have state taxes have pretty high property or sales taxes, and that's how they generate the revenue for the state. But importantly, you also have to factor in the cost of healthcare. And I'll just give you an example here, which is, I think many Americans think about moving to Florida as an example for retirement. There are many benefits to living in Florida. My own in-laws are down there right now. But I would just flag that while there is zero state tax in Florida, it happens to also be one of the most expensive places to buy Medicare Advantage or to buy Medigap insurance. And so as you think about where you live in retirement, would really encourage you to think about not only just the taxes, but think about the healthcare costs, the cost of living, so that you really understand, how long your savings are going to last in retirement. If you are thinking about moving, a couple specific tax considerations to take into account. The first that I think probably everyone knows is that on your primary home that you do have a $250,000 exemption for single filers or a $500,000 exemption for joint filers if that home is your primary residence. If you're thinking about going back and forth between two states, you really need to understand what the residency requirements are. I would also just double tap on that to flag that where you are resident also impacts where you buy your Medicare. And so really understanding what the cost of Medicare is in the state that you're currently residing in versus the state you're thinking about residing in. And then, as you think about, maybe you're going to be based in two states, just take a look at what the property tax situation is and whether or not you'll be able to deduct your property taxes on your second home from the state that you're actually filing your taxes in. All right, let's talk about minimum distribution requirements. So let's just kind of take a little bit of a step back. For many of you on the phone, you've been saving for retirement in a 403B or a 401k. These accounts allow you to defer the taxation of your retirement savings until you start taking money out of your retirement accounts. But the IRS comes in and says, look, we want to make sure you take money out of your retirement account. There's an age by which we really want to make sure that you're not getting tax-free returns forever. And so it used to be that starting at age 70, you were required to start taking money out of your 401ks. Then with the passage of Secure Act 1.0, it was delayed to age 72. And just this past new year, RMDs were delayed again. If you were born before, if you turned 73 before or after, sorry, this past New Year's, your RMDs now are based on you turning 73. And in a couple years' time, that date will actually be delayed out to age 75. What this means is that you get more time to have your assets accumulating without being required to withdraw from your accounts. My own dad has been taking out his RMDs this past year for the first time, and I think one of the things that he's observed is that it's made his tax situation a little bit more complicated because it's a pool of capital that he hadn't planned on perhaps withdrawing from. And so just making sure that you're planning around that required minimum distribution if you've hit age 73 or above will be important as you do your tax prep for the year. Again, as I mentioned, the Secure Act, which passed at the end of the year, changes that required minimum distribution to age 73. And by 2025, that minimum distribution requirement will get pushed out to age 75. So one of the questions I get a lot from members is how to think about reducing your required minimum distributions. The first thing I would just flag is that required minimum distributions are based on what your account balance was from the prior year. So if you're taking RMDs this year, it's based on what your requirement or what your account balances were on 12/31/2022. I think last year was a really tough year for retirees who were taking out RMDs because the balances were struck at the start of the year. And for most retirees, their retirement accounts dropped, 15 to 20% if they were fully invested in the past year. So the first thing around just managing your RMD is really thinking about having a withdrawal plan. Many members I speak to think about doing it on a monthly basis just to have that stable withdrawal. It also takes market timing off the table, but really having a plan, because what we don't know is which way the markets are going to go. And I know many retirees last year felt like because they hadn't created a plan that they were forced to take money out in a down market, which wasn't something that they felt really good about. The second thing to think about is that in a down market, it may make sense to consider rolling some money into a Roth. And a Roth IRA allows you to really to not have RMDs anymore. And while you pay taxes on the conversion, it allows for tax-free distributions of the money in the future. There's a lot of chatter about Roth IRAs right now, and it's really because when you do a Roth conversion from a traditional IRA, you pay taxes on the value of that IRA before the money goes into the Roth. Because account values have come down over the course of the last year with the markets, many retirees have been looking at Roth IRAs again as a potential way to really manage their RMDs, but also put more money away in a savings account that won't be taxed on the withdrawals. All right, so let's talk about a couple of the big moves you can make. So I started out this conversation today talking about the specifics of the 2022 tax prep. We are, though, however, already in 2023. So while you're filing your 2022 tax return, a couple of things I want you to think about as you plan for 2023 and beyond. Some of the big moves that you can make, we just talked about Roth conversions. So in a world where the markets have fallen, if you've been considering a Roth conversion, it may be less expensive to do that Roth conversion today than it was over a year ago. The second is that if you find yourself in a high deductible healthcare plan and you can make space to put money in an HSA, that this is a space that can play really huge dividends in the future. I think we all know that healthcare costs in retirement only go up, and being able to access funds in a tax efficient manner to pay for healthcare costs can be really attractive. And then finally, if you consider moving in retirement, it can be one of the biggest retirement decisions you make. It's obviously a very personal decision about where you want to live, but would just encourage you to think a little deeper, not just about taxes, but the total cost of what retirement looks like. And then as we look out, what I would just say is I walked through a lot of numbers today that are about your 2023 tax return. You're going to see some additional increases. Sorry, I walked through the numbers for the 22 tax return. When you start thinking about 2023, what you're going to see is another round of inflation-driven adjustments. And so you're going to see all the numbers that I talked about this year. You're going to see bigger increases next year. because IRS has already announced that because inflation was so high that all of their inflation adjustments would follow and make larger increases in tax brackets and bigger increases in what the contributions could be to things like 401ks. So if we just recap what we've learned for pre-retirees, it's really about how do we maximize your retirement savings. These higher tax brackets allow you to put more money in your savings for retirement. For retirees is really making sure you're taking advantage of the credits and deductions that are available to folks that are typically age 65 and above. And then finally, it's not to forget the big moves for 2023. If you go to itcu.silvur.com, you will be able to access our new tax filing guides. We have 2 classes that we've just released today. One of the tax filing guides, which goes into all these numbers. If you've got questions afterwards, I want to remind yourself about any of the numbers that I've talked about. What you'll find in the tax filing guide is we have one guide for pre-retirees, and we have a second guide for folks that are already in retirement. And so hopefully those classes really help you get the information that you need for your tax filing. I also wanted just to flag that when you go into itcu.silvur.com, what you'll also find is a bunch more lessons that really help educate you on some of the big decisions that you're going to be making around retirement that are tax related. And so if after learning a little bit today about how Social Security is taxed, you have more questions, we have a class that is specifically dedicated to how Social Security is taxed. If you're thinking about moving in retirement, I'd encourage you to read our class on how where you live impacts taxes. And then, in this market that's a down market, we also released a class at the end of last year, which is a tax tips for retirees in a down market. So things that you can take advantage of that are specific to the market environment that we're living in. All of these classes are really easy to get started. They're typically 1 to 5 minute reads. And so would encourage you just to get started on learning and really make sure that, again, as you're going through this process of preparing for retirement or being in the early days of retirement, that you're keeping what's yours, that we're not giving too much to Uncle Sam. And our goal with InTouch is just to make sure that we're helping demystify some of these rules that at times can be pretty complicated. So with that, Josh, I think maybe we'll open up to Q&A and see what questions we have that I can answer.
Awesome. Thank you so much. We do have a few questions that came in, and I would like to point out I signed up for Retirement Simplified myself at the age of 36 because after going through this with my father, I was motivated, aka scared, into learning as much as I could. So it is a very wonderful site. We appreciate you putting all that together for us. So we've got, we still have some questions coming in. So the first question is, do you have to be 65 or have turned 65 in 2022 to get the additional standard deduction, or do you have to be 65 when you file?
Yep. So the answer to that question is that you need to be 65 in the filing year, and you're considered 65 on the day before your 65th birthday. So I guess IRS gives you one extra day. So if you turn 65 on January 1st, 2023, but on January 1st, 2023, it would actually count as being 65 in the calendar year 2022. But if you turn 65 April 15th of this year, that will only count for the next year tax filing, not for the 2022 tax filing.
Next one, and actually I'm interested in this one too, so I'm glad this person asked. Can you only take the medical cost deduction if it exceeds the standard deduction?
Yeah, so normally to claim a medical expense deduction, you need to itemize your deductions. And so itemizing typically means that you don't take the standard deduction. So if you're going to be claiming the medical expense deductions, it's typically because your itemized deductions are going to be greater than your standard deductions.
Yep. And I want to add that I did take that option one time after a major surgery. I just handed everything over to a CPA. I'm like, here, I don't want to mess with it. So I would advise, if you ask that, to seek out a tax professional if you're looking to do that, just as Rhian said with the itemized deductions. This is a really good one. My daughter just graduated and has yet to get a job. Can I contribute to her Roth IRA? And will she be paying any tax against this contribution as income?
That's a really good question. So first of all, kudos to you to be thinking about having your child start their retirement savings early. I think as we all probably on this phone realize that time is one of the greatest gifts that you can give when it comes to retirement savings. So putting money in a Roth right after graduation is really an amazing gift. So a parent or another adult can contribute to a child's Roth IRA. So long as the child has earned income for the year. So your child does need to have some earned income in order for that Roth IRA contribution. But Roth IRAs, as you may recall, are funded with post-tax money. So it isn't a taxable event for your daughter, but she does need to have some income to qualify to contribute to a Roth IRA.
Awesome, thank you. If someone dies during the year, does their heir have to take a required minimum distribution the following year on their IRA? There's a follow-up to that is it based on their heir's age or the original owner's age?
Okay, so Linda, I want to just tell you on this one that it's a little complicated. So what I would love to do here is if we can get Josh, if we can get Linda's contact details, I would love just to like follow up with a specific email because I just really want to make sure that we get the answer right to you there. So apologies for not giving it live, but there's a little bit of nuance here that I want to just take a quick look at and get back to you.
And that's okay. In these webinars, there's always going to be unique. Everybody's situation is unique, right? So
yeah, but Linda, if for some reason Josh doesn't have your details, you can email support@silvur.com and we will get you an answer. But otherwise, we'll work directly with Josh to get you an answer.
And Linda, if you just want to shoot me a private message through here, giving me your consent to reach out, or you can send an email. I'll put our webinar email in the inbox. You can send that to me and I'll pass that along. All right. This one is asking, is they think they heard do something different that affects the Social Security is taxed differently after age 70.
Yeah, no. So Social Security, there is no difference on what age as far as the taxes. So whether you take your Social Security at 62 or 65 or 70, it's taxed the same way. And I think what I had walked through is that there's this concept, you're basically taxed based on what your income looks like. But what I just flagged is that the income isn't just plain adjusted gross income or AGI, which is typically what most thresholds are. It's this concept called combined income. So there's a little bit of nuance there. But what I would just say is that no matter what age you are when you take Social Security, up to 85% of it will be taxed. And so it was just really making sure that you're aware of that. And the second thing that I had mentioned was just know that when you get your first Social Security check, if you haven't filed for the withholding, it will be pre-tax. And so I would just encourage you to think about whether or not you want to put in withholding because it isn't done automatically for you.
Thank you. This is not a question, but a very sweet comment that says, no question, but thank you for such an easily understandable presentation. You're welcome. We strive for that. All right. Oh, this is a good one. How old can you be to set up a donor-advised charitable account by transfer money from your IRA?
I do not know that one off the top of my head. So I think we're going to have to put that in the bucket with our prior question, which is, Alan, if you can either give Josh consent to have your details, we'll reach out, or if you can email support@silvur.com, we'll get you the answer.
Yeah, and I will say even that I from a financial counseling point of view through my training, I think there are going to be several follow-up questions that we'll have to get before a complete concrete answer. Yeah. Next question is, can you retire at age 62 and are you allowed to continue working and how many hours? And that sounds like a two or three parter answer there.
That's a good one. So I think the first thing is, this is a really common question. I think the old days, of Americans retiring cold turkey and retiring cold turkey and not going back to work is actually quite uncommon. And so we typically are seeing Americans going back to work part-time. The key thing with is whether or not you're taking Social Security. And so Social Security has a maximum amount that you can earn before they start withholding your Social Security. And so if you take a look at itcu.silvur.com, we have a class actually on working part-time and taking Social Security. And it goes through all the details of like how much you can earn before Social Security starts withholding. But you certainly can retire early and keep working part-time. It's just a question of what might the impacts be for your benefits.
Awesome. I am planning to continue to work, but that's just because I'm the type of person who can't sit still. So that's what I'm planning to do. Our next question is, what is the max IRA contribution for 2022 if you are contributing to a 401k and over 65?
Okay, that's the math is moving a little too fast for me. So I think, Cindy, why don't we
Okay.
just get you that answer offline? Because I need to pull together a couple things live that I can't do quickly on this call.
All right. And again, the email for questions is in the chat for everybody. So if you can send us a direct one there or send me a private message with consent, and I will get that over to Rhian. Next question is, my husband is 65 and I am 62. We filed jointly. Can we deduct for the retirement deduction?
Yes, so it'll be based on the filer, and so when you put in your age, it will recognize what your age is, and you will get the credit for the older filer.
Thank you. Now, I like this question. Say you retire early with a strong cash position. Does it make sense to still draw down IRA funds at a lower tax rate prior to the RMD forcing you into the next tax bracket?
All right. So this one is complicated. It's a really, really smart question to ask. And I unfortunately would have to say that it depends. And that's because we've built software that addresses this question. And I think what you're really trying to get to is this concept called account sequencing. And if you have money sitting in a taxable account, a Roth IRA, and a 401k, where do you take your money from first? And it really, what I'd say is at the end of the day is the reason it depends is a couple things. It depends on how much money you have in each of these different accounts and what your tax status actually is, and where you live, because depending on whether or not you're paying state taxes can impact the answer. It also depends on what your goal is. Like, is your goal to save money for your heirs, or is your goal to pay as little tax as possible during your lifetime? And depending on what the answer to that is, you may have different, there may be different recommendations on which account you pull down from first. So what I would recommend here is we have a class in Retirement Simplified that's specifically focused on withdrawal sequencing. And so if you go into itcu.silvur.com, you hit on the taxes classes, you'll see a class in there that's specifically focused on withdrawal sequencing and helps you kind of go through the what if scenario based on what your goal is around which strategy makes the most sense.
Right. And I want to remind everybody, these are all great questions, but if they are super specific questions, just know that those will probably have to be taken offline, just because this is a very general forum and we want to answer as much as we can. And we do want to get to your questions, and we will, but we do not want to give very honed in advice on something that's not going to affect most people on this call. Not that it wouldn't, but just want to make that again. And then Rhian, this is a kind of a follow-up question to the earlier one about the child contribution to their IRA. It's asking, wouldn't the contribution to the Roth IRA be a gift and not taxable to the child unless you have given her more than the $16,000?
So the total contribution, the amount you can give to one person can't exceed $16,000. So you're right. So you can't give someone a Roth IRA account, but you can make a contribution for their Roth. But again, I can triple check, but I'm still pretty certain that the rule requires that she be working and have some income in order to be eligible to receive a Roth. But that's the piece I wanted to triple check for you.
Awesome. All right. So, Debbie, if you can either send me a private message or send an email to there, we can get a more concrete answer for you. Ooh, this is a good one. Can you explain the distribution of an RMD from an IRA and a 401k to a QCD?
Yes. All
Not
right. So this is what I love about retirement. Lots of acronyms, right? So first of all, let's go through what each of these acronyms mean, and then I'll answer the question, because I'm sure for many people on the phone who are listening along, there may be some new words here. So RMD, required minimum distribution. That's what you need to take from your IRA or your 401k once you hit either, it used to be 70, now it's 73, and then it'll be 75 soon. So you got to love everyone in Washington always changing the rules on us. A QCD is a qualified charitable donation. You are eligible to make qualified charitable donations once you turn age 70 and a half. And what this allows you to do is to make a donation directly from your IRA or 401k to a charity. And instead of taking the money out of your IRA or 401k and then giving it to charity, which would be a taxable event, it allows you to take money directly from your IRA or 401k and donate it directly to the charity. The key thing is it has to be a direct donation. When you are making that donation, you need to make sure that the charity knows how to do that. Most established charities are very familiar with the rules are, because the transfer has to go direct from your IRA to the charity. You cannot have it go through your bank account. But as you mentioned in this question, if you have a required minimum distribution that you need to make, you can kind of use up some of that requirement by making that donation. So let's say your required distribution for the year is $5,000 from your IRA, and you want to make $1,000 donation to your local charity. If you make that through a qualified donation, you only then have $4,000 left that you need to make for your RMDs.
Thank you. In finance, there's already enough acronyms as it is. So now when you're getting into retirement acronyms and legal acronyms,
Yes.
There needs to be an acronym dictionary is what there needs to be. This one is asking, going back to work after you've retired, and you're on Social Security and over 65, what should you check for? So I'm guessing he's asking what questions should you be aware of
Yeah.
before you make that leap?
So it's a really good question. So the first thing I would say is I'm going to give you a quick answer here, but we have an entire class on itcu.silvur.com that's all about working part-time in retirement. And so it goes through all the details. I really think the most important thing is really understanding whether you're subject to the clawback rule for part-time work. And it really goes to what's defined as full retirement age. So depending on when you're born, your full retirement age when it comes to Social Security is somewhere between the age of 65 and 67. And in the class, we go through the specifics so you can look at your date of birth and figure out what full retirement age is. If you are not at full retirement age, then Social Security does have a cap on how much you can earn before they withhold it. They will give you the money back in the future, but it's just important for you to know that you won't get it in the current year. The second thing to think about is if you are over the age of 65 and you're thinking about going back to work, is just taking a really careful look at the healthcare options you have. There is definitely, I think a lot of early retirees really like the idea of getting healthcare benefits when they work part-time. It gets a little more complicated once you're eligible for Medicare. We do have a class that goes through all the details, but I would just tell you that you really need to make sure that if you are getting healthcare benefits from a part-time employer, that you really understand what you still have to enroll in for Medicare. Because if you miss some of those enrollments because you think you don't need them, you actually can get penalized in the future. So I would just be very careful and look at the details. Like if you are going to take a healthcare plan from a part-time employer while you're over the age of 65, really make sure you understand how that works with your Medicare. The HR department should be equipped to help you think through that. And then also on Medicare.gov, there's a great primer on working and receiving Medicare. I think so. The next question I see is on Social Security disability income. And Jerry, I have to just unfortunately tell you that this is an area that I am not equipped to answer. We do not currently have capabilities on SSDI, but it's something that I hope we'll be able to build out to support members like you in the future.
Thank you. And this one, Karen, I'll take this one. Yes, we do offer financial counseling here at InTouch Credit Union. It is complimentary to our members. You can send an email to the community at itcu.org inbox to schedule that with us. It just depends on where you live. We do have counselors in Texas, Michigan, and Nevada. While Rufus and I head up that group ourselves, we want to make sure to direct you to a person in your area. And if it's not in your area, we will direct you to somebody who can assist you in your state. All right, and this one is asking, what, if any, situations prevent converting a traditional IRA to a Roth?
So it's a good question. What I would just say here is it's really going to depend on your fact pattern, but let me maybe just flag a couple items for you just to think about. So the first thing to be thinking about is it's really when you do a Roth conversion, what you're thinking about is your taxes. And what you're trying to do is oftentimes for an heir, you're thinking about like, if I'm going to be donating money to an heir, to a child, for example, that's going to have higher income, it may make sense to give them a Roth rather than a 401k. And so if you're in a year like this year, maybe you have lower income, your balances have dropped, and that it isn't as costly for you to do that rollover, it may make sense. One thing I would just flag that's really important to take into consideration is that if you do a Roth conversion, the year that you do your Roth conversion, it will trigger income tax, right? So the rollover from a Roth or the rollover from a IRA or 401k to a Roth typically is treated as income. And that can actually impact your Social Security or Medicare benefits. So we've talked a little bit today about how Social Security is taxed. It's about this concept of income. And so if you're doing a big Roth conversion, you're going to have high income. So it's really going to make result in your Social Security being taxed. It also, if you're doing a very large Roth conversion, could throw you into what's called IRMA, which is a surcharge associated with Medicare. So Medicare has a surcharge on Part B and Part D, which is Medigap insurance, sorry, the drug plans. And when you are subject to IRMA, you have a higher premium that you're paying for a couple year period of time. IRMA is based on what your income is. And so if you're defined as having high income, then you will be charged a surcharge on Medicare. And again, even if you're not receiving W-2 income, that rollover of an IRA can trigger you being put into IRMA surcharges for a period of time. And so I think like a lot of what we've talked about this today is, the strategy here, unfortunately, is really based on trying to understand like what your goal is. Is your goal to get more money to your kids who have more time to compound? Is predictability for you important? Do you how do you feel about paying IRMA surcharges for a period of time? And so really needing to take all these factors into consideration is where I think a good accountant and the wealth management team at InTouch, I think, can help you put together a more formal plan.
And for those of you on the call, yes, we do have a partner who handles our wealth management programs. So anything from retirement planning, investing, all that kind of stuff, you can visit with your local branch or connect with our call center, and they can put you in direct touch with that team. Maria, that is all of our in-webinar
I got one. I think we just got one more.
Oh.
So the question that we got was, can RMDs also force IRMA? So again, can a required minimum distribution trigger this Medicare surcharge? And the answer is yes. So when you think about what an RMD is, it's a withdrawal from your retirement account. It's treated as income from a tax perspective. And so it definitely can trigger IRMA.
Thank you. So I have two questions. that we got beforehand from some of our team here. Um, and I'm also interested in these two. So the first one is, are there any taxes that an individual would stop paying in retirement?
Oh, it's a good question. Well, look, you're less likely to be getting W-2 income, right? So that's the first thing. And so you still have income, it's just your mix of income changes. And so another class we actually have in Retirement Simplified is a class that covers all the new tax documents you're going to start receiving when you retire, which is again kind of wild. Like you've kind of gotten used to all the tax paperwork that you receive pre-retirement. But once you start taking money out of 401ks or receiving Social Security, you're going to get a whole new set of tax paperwork. So I'd say you're less likely to have a W-2 income. There are a lot of states and municipalities that will reduce your property taxes once you're retired or once you've hit a certain age. And the thought process behind that, just quite frankly, is if you think about property tax, a large percentage of property tax often goes to schools. And so the thought process is that if you're already retired, you're not really benefiting from sending family members to a local school. And so you're going to get a reduced tax or property tax as a result of having a certain age. So those would be the two that, would be probably like be on my radar. But again, it's like, yes, a whole new set of paperwork to follow, which is, again, it's kind of mind boggling. But again, making sure that you're whether, I'll give a personal example. My father, as he embarked on retirement, he did move a few streets, and those few streets was the difference between, a very big school district with a lot of taxes and a very small school district with a lot lower taxes. And so just being savvy, like you don't have to move state, you could just move within your city to get into a lower tax, a lower kind of municipality tax rate based on how those taxes are spent.
That's a good point, Rhian, because especially if you are in our Michigan or Texas markets, you could live in one city but but that city could have 4 different school districts tied to it based on your address. So that's a good tip. The last question I have, unless we get more popping up here, is if my partner died and I received a life insurance payout during that tax year, will I have to pay money on the life insurance payout?
So I don't know if this is coming from the line or to someone at ITCU, but my understanding has always been that life insurance policies are not taxable. But obviously that's a big statement, and I'll just triple check that for you. But that has always been my understanding, is that most life insurance policies are not taxable.
Okay, good. And this person's commenting on from your question earlier, not a question, but and I need to know where this person lives. They get a 10% discount on their water bill
Yeah.
at age 65.
But this is great, right? These are some small things can add up. And this is where, asking what the discount is for quote unquote senior citizens or, members who are over the age of a certain age, like, you've worked really hard to save for retirement, and these small dollar amounts, these discounts every month can actually add up and can give you back cash to spend on things that you really want to spend your money on.
Absolutely. Well, if there are no more questions, we can wrap it up just a couple minutes early, but this was very informative, Rhian. We've gotten a lot of positive feedback, lots of great questions, and thank you all for sending me messages. We will definitely get you all in touch with those, and we have a copy of all of your questions during this webinar too, so they're not going to disappear after we all leave today. Rhian, thank you so much for giving up your time for you and your team to not only create this for us, but present today. And for everybody on the call, we will have Silvur back out again throughout the year. They have such a wider range of topics that they can talk about. So please consider signing up for Retirement Simplified and taking those courses, getting those updates. The team works very hard to provide all this, and we are so grateful that they have chosen to partner with us for the benefit of our members. Did you have any closing words? I don't want to steal your thunder here.
No, that's, again, it's like we know that retirement's complicated, and our goal is to help you retire with confidence. And so we're thrilled to be partnered with InTouch. This is a free member benefit. So any member over the age of 50 has access to this platform where we are delivering up-to-date education about retirement, making sure that, again, you feel confident making your decisions and that you understand what the new rules are. Because I do think, things are changing all the time. We want to really make it easy for you. So we're we're really thrilled that InTouch has recognized how important this education is, as you navigate this next phase of your life.
Absolutely, yes. Working for our members and their financial well-being. That's our motto. Well, again, thank you, everybody. We hope to see you again. Please stay in touch with your emails, our website, and our social media handles to see the next upcoming webinars coming down in the future. Have a great day.